Alright guys, back with another video. We're talking about making recommendations and the risks that come with making recommendations. So it's important to remember the greater the risk that investors are willing to take with an investment, the greater the potential reward should be. In other words, safe investments tend to offer lower yields, but investments with more risk should offer much higher potential gains. In addition, different types of risks can be associated with different investments and securities. Investors should be aware of the risks they take with any investment, be able to afford the risk, and be comfortable with doing so. Securities industry professionals should understand the many types of risk. Helping our customers understand these risks is part of determining suitability. Just as every investment is different, so is every investor. So, several types of risks must be considered in determining if an investment is suitable for an investor. Now, the first type of risk is systematic risk. Systematic risk is a risk associated with changes in the overall economy. These changes will have a negative effect on individual securities regardless of the company's strength. Systematic risk is generally caused by factors that affects all businesses, such as war, global security threats, or inflation, are examples of systematic risk. Meaning, no matter how diversified a portfolio of investments is, it will still be subject to systematic risk. You can't diversify away systematic risk. Systematic risk cannot be diversified away. Types of systematic risks you have include market risk, which is the risk that when the overall market declines, so will any portfolio made up of securities from that market. So if an index of large stocks is falling, a portfolio of large stocks would likely be falling as well. Or the number of stocks and the diversity of the portfolio doesn't matter. These investments could not escape a large fall in the market. Other type of systematic risk is interest rate risk, which is defined as a potential change in bond prices caused by a change in market interest rates. If interest rates rise, existing bonds with their lower coupons in comparison will be viewed as less attractive and will go down in value. If rates fall, the existing bonds with their higher coupons in comparison will be viewed as a desirable and will increase in price. So in other words, prices of bonds have an inverse relationship with interest rates. Interest rates rise, the value of bonds fall. The price of bonds fall, and vice versa. And then you have inflation risk. Inflation risk is sometimes called purchasing power risk, where it is the effects of continually rising prices on a fixed investment income. So inflation risk, if an investment income is a fixed amount, the purchasing power of the income diminishes over time. That's inflation risk. The value of your dollar diminishes over time in fixed securities. And then you have examples of unsystematic or non-systematic risk. Non-systematic risk can be reduced through diversification. So that's an immediate difference. Systematic risk cannot be diversified, whereas non-systematic risk can be diversified. Non-systematic risk is the risk that is unique to a specific industry, business, or investment type. So examples of non-systematic risk would be credit risk, which is the potential for an investor to lose some or all of their money, their invested capital, because of an issuer's financial strength. So credit risk includes the risk that a debt security will fail to make interest payments, or the risk is most common associated with debt securities, you could think. Credit risk is also called financial risk or default risk. So think a company not being able to pay off their debts is credit risk or default risk. And then you have capital risk, which is the risk that an investor will be unable to get all of their original investment back. Capital risk varies depending on the type of security and the specific issuer. Capital risk is effectively zero for securities issued by the US Treasury. And capital risk is very high in options. Another type of non-systematic risk is business risk and liquidity risk. With business risk, it is an operating risk that is generally caused by poor management decisions of a particular business. And then liquidity risk is the risk that an investor might not be able to sell an investment quickly at a fair market price. Liquidity risk is also known as marketability risk. A few other non-systematic risks would be regulatory risk, which is the risk that a new regulation or a new way of enforcing an existing regulation can affect a business. Sudden changes in regulation can harm businesses and industries very quickly. So any questions mentioning regulations being changed, that's regulatory risk. Legislative risk is another non-systematic risk. With legislative risk, you want to think changes in laws. When you see laws, think legislative risk. The risk that a change in the law may impact a business. Changes to the tax code is an example of legislative risk. Then you have political risk, which is most associated with political instability in emerging economies. And last type of non-systematic risk you could see on the exam would be sovereign risk. Sovereign risk is the risk of a country defaulting on its debt obligations. When a country is at risk of defaulting on its debt, the impacts is felt on financial markets worldwide. Other types of risks an investor could face is call risk. Call risk is the risk that a bond might be called before maturity, and an investor will be unable to reinvest the principal at the same interest rate. Call risk can lead to reinvestment risk. That's basically if an issuer decides to buy shares back that they issued or buy bonds back that they issued and reissue it at a lower rate. That would be a call risk to investors. Call risk can apply to bonds and it can also come with preferred stock, specifically callable preferred stock. You can also consider currency risk, where currency risk is the possibility that an investment made in a foreign currency could decline if the value of that currency declines against the US dollar. So now when it comes to risk and investing, risk is a constant in investing. If there is no risk, the rewards are very small. There are several strategies of reducing risk in investing, and diversification is one of those primary tools, mainly to destroy unsystematic, non-systematic risk. Now, as far as ways to mitigate or reduce systematic risk is risk that is built into the system. There are two ways to reduce systematic risk, which is hedging and portfolio rebalancing. With hedging systematic risk is done by purchasing a security that moves in the opposite direction of the portfolio you are hedging. Portfolio managers will often use options to hedge the portfolio risk. So, in other words, you're just buying into the opposite position of the position you currently stand, is a way to hedge risk. You're thinking something is going to go up, but there's a possibility of something could go down. So you invest into the possibility of something going down the same way you invested in the possibility of something going up. That's how you hedge against your position. With portfolio rebalancing, it's a part of asset allocation. A portfolio can be regularly rebalanced to take profits from securities that have gone up in value and buy into areas that have decreased in value. An asset allocation strategy produces steadier returns with less volatility than a portfolio that is all stocks or all bonds. So the two ways to mitigate systematic risk is hedging and rebalancing, also known as asset allocation. So, when it comes to making investment recommendations, the registered representative plays an important part in helping clients reach their goals. So when an associated person like a registered representative provides information that a reasonable person would view as suggesting a course of action regarding a security, a class of investment, or an investment strategy, that person is making a recommendation. A person making a recommendation should consider factors around the communication. What is the knowledge level of the person they are speaking with? If a reasonable person in the same circumstances might have considered it a recommendation, it's a recommendation. So, in other words, intentions don't matter. A recommendation is a recommendation. If a regular person considers the words you are saying as advice, that's considered making recommendations. No matter if you intended to give a recommendation or not, a recommendation is a recommendation. Recommendations can be advice to buy or sell a security, or invest in or sell a sector or industry. Recommendations can be advice to hold a security, employ an investment strategy, or open an account. When it comes to what is known as regulation best interest, on June 30th, 2020, the Securities Exchange Commission, SEC's regulation best interest became effective. Regulation BI established a new standard of conduct under the Securities Exchange Act of 1934 for broker-dealers and associated persons of a broker-dealer when making a recommendation of any securities transaction or investment strategy involving securities, including account recommendations to a retail customer. Under Regulation Best Interests, Reg BI, any member or associated person making a recommendation must exercise reasonable diligence, care, skill, and prudence in making the recommendation by doing a few things such as acknowledging the potential risks, rewards, and costs associated with the recommendation, acting in the best interests of a particular customer based on that retail customer's personalized investment profile, believing that a series of recommendations, while in the customer's best interests, when viewed in isolation, is not excessive and unsuitable for the customer when taken as a whole. Followed by identifying conflicts of interest, such as sales, contests, or bonuses based on the results of a recommendation, and disclosing and mitigating them or eliminating them all. So always want to remember you want to disclose any conflicts of interest, such as a bonus or a sale commissions made in regards to making recommendations. And understanding some market indices. Indices track market performance and serve as a baseline for active managers. So these are a few indices that track the domestic equity markets. First, you have Dow Jones Industrial Average, which is the most widely cited measure of the market's performance in the popular press. DJIA tracks the performance of 30 stocks of large, well-known companies. After Dow Jones, you have the Standard & Poor's 500, S&P 500 index. S&P 500 index tracks slightly more than 500 stocks of large U.S. companies and is the basis of several index mutual funds and exchange-traded funds. The S&P 500 is the benchmark of most professionals when speaking about overall market performance. After S&P 500, you have Russell 2000 index. The Russell 2000 index tracks approximately 2,000 small company stocks and serves as a benchmark for smaller companies in the overall market. And then you have Wilshire 5000, originally tracking over 5,000 stocks. Wilshire 5000 covers all the companies listed on the major stock markets, including companies of all sizes across all industries. And when it comes to major bonds and international equity indices, you have Bloomberg, Barclays US aggregated bonds. The AG is a composite index that combines several bond indices. to give a picture of the entire bond market. And then you have the MSCI EAFE index. This index is designed to measure the equity market performance of developed first world markets outside of the United States and Canada. It is maintained by the MSCI Incorporated. The EAFE stands for Europe, Australia, and Far East. EAFE, Europe, Australia, Far East. This is the most widely recognized index for foreign equities. So when you see MSCI EAFE, think foreign equities, index for foreign equities. And lastly, to wrap up this video, it's always important for broker dealers to understand their customer, which is a requirement through FINRA. When it comes to considerations of understanding your customer, you have financial considerations and non-financial considerations. You want to remember examples of financial considerations would be income, value of their home, liquid net worth, debt payments, and total debt. Income, value of their home, liquid net worth, debt payments, and total debt are examples of financial considerations. Non-financial considerations would be the customer's age, the customer's marital status, the number and age of the customer's dependents, the customer's employment status, and the employment status of the customer's immediate family members would be non-financial considerations.